Here are 3 mortgage myths that are costing buyers thousands. If you still think you need 20% down to buy a home, this video is going to save you years of waiting. Myth number 1, that you need 20% down to purchase a property. If you're looking to put less than 20% down, the minimum down payment in Canada is 5%. So from 5 to 19.99% down, you can have for a down payment. These funds can come from savings, a gift, long-term investments. They can be borrowed, whether it's from a line of credit or RRSPs. Funds can be from a variety of sources. With lenders, the big red flags for down payment are from crypto, money overseas, money coming from sanctioned countries, gifts from individuals that are not immediate family members, so father, mother, sister, or brother. Those are some sources that many banks have difficulty confirming for down payment and are not okay with. Now, when you put less than 20% down, there's what's called default insurance that's added on top of the mortgage, and you pay that over the lifetime of your mortgage. So the benefits of some people saving for 20% or more down is that they avoid the default insurance altogether. Now, if you're a first-time home buyer, the most important part of saving up for the down payment is so you can get into the market. So don't stress about having 20% down to avoid paying the default insurance. You can make up for that by increasing your payments, doing accelerated payments, which means you basically make one extra monthly payment throughout the year and it speeds up how long it takes to pay off the mortgage. Or you can do increased payments or lump sum payments over time directly towards the principal to help make up for that added default insurance cost. Now, myth number 2, that you need perfect credit in order to buy a house. Let's be honest, if you're trying to buy your first home, chances are your credit is not perfect or anywhere near 900, which is a perfect credit score. You're probably in the 600, 700 range, and that is totally okay. Banks are looking for missed payments, any judgments against you. They want to figure out what is your pattern of credit. Because if you're going to be taking on a large mortgage payment, they want to make sure that you've also been able to pay for your daily living expenses through credit cards or lines of credits or auto loans. So if your score is below 680, some lenders will deny you when you're trying to apply for a mortgage. Now, there are exceptions. Sometimes we can get deals approved on the A side, which is the bank with less than 20% down, even if your credit score is in the low 600s. If we can add on a strong co-borrower who has good credit and good income stability, then it may help get the deal approved. So no, you do not need a 900 credit score in order to get a mortgage approved. But we do need to make sure that you're making your payments on time. And obviously there are situations where you may have missed payments once in a while. Maybe you forgot to set up your auto withdrawal from your bank account to pay off that credit card, or you went away and you forgot to make your bill payment for the month. Lenders understand that. But when there's been multiple missed payments after another on a credit card or on a line of credit, they start to ask questions. One-time blemishes, if it happens a couple of times, we can come up with a good story based on your situation to help sell your deal to a lender. Now, if you're looking to build up your credit, just while we're on this topic, a few ways to do that is to have a few different trade lines. So a phone bill show up on your credit card. If you have a Visa, maybe also look at applying for a MasterCard. It's a different brand and it helps. You can also focus on reducing your utilization. So anytime your credit balance is above 50% of your total limit, we'll start to see your credit score drop. And that's because it's considered high utilization. So look at adding an extra trade line, keep your utilization low, and always make your payments on time. And finally, the last myth I hear most often is we need to wait for rates to drop in order to buy a house. What I'll tell you is this: it is very, very difficult for anyone to predict where the rates are going to go. It is. Market's changing, economy's changing, there's problems happening all across the world that impact our market, and bond yields, which affect fixed rates, or the Bank of Canada, which dictates variable rates. So it's tough to predict where we're headed. Nobody has a crystal ball. But what I can tell you is that the longer you wait to get in the market, in most cases and in past history, the more expensive things will get. So if you're waiting for rates to come back down to 2% or 1%, like it was during the pandemic, you will be waiting a long time. Truthfully, I think rates will stay between the 3 to 4% mark for the next little bit. So don't wait. Make sure you get a pre-approval in place so that way you're ready to buy if that perfect house comes up. But waiting for the rates to drop below 2% may not be reality. If I can provide any advice, it's get in touch with a mortgage professional like myself. We'll provide you with the facts, we'll provide you with advice, and we'll make sure that we come up with a strategy for home ownership. Looking to learn more? Give me a call, 226-787-4745. I'd love to connect with you.